How to invest smart when the market is shaky. Hey savvy investors, welcome back to Investment Mindset. If you are feeling anxious with all the market chaos lately, tariff, inflation, tax sell-off, you are not alone. Today, let's cut through the noise. We'll talk about what is really causing this volatility, how you can strategically position your portfolio, and most importantly, why this approach works even in uncertainty. So, what is going on? Right now, the top concern among global investors is the return of the trade war drama. President Trump's latest tariff threats, including a 25% slaps on iPhone made outside the US and up to 50% on EU goods, have the market spooked once again. Sticky inflation, interest rate fears, Middle East tensions, and fears that tech is too frothy is a perfect recipe for market mood swing. But here's the truth. Market don't like uncertainty, but uncertainty also equals to opportunity if you know what to look for. So instead of panicking, here's how smart money plays it. First, focus on modes and cash flows. Ask yourself this: is this business so good it can survive tariff, inflation, and even a TikTok ban? Look for companies with strong ROIC or return on invested capital, free cash flow yield of more than 4%, low debts, and with pricing power. Because when storm hits, it's the strong swimmer who stay afloat. For example, stock like Bursa Malaysia has a consistent ROIC above not only 15% but 20% with free cash flow yield above 4.3%. And if a stock is trading at 7 ringgit and 69 cents and has a 4.37% free cash flow yield, this means the company is generating 33.6 cents per share in real cash every year. This is cash left over after all business expenses, taxes, reinvestment, and operation. The cash the company could use to pay dividends, buy back shares, reduce debts, or reinvest into growth. And the one stock which has ROIC consistently above 15% trading in the US exchange is Qualcomm, with free cash flow yield of 7.4% as of 23rd May 2025 and debt to equity of 0.53 only. And going by the general rule of thumb, debt to equity ratio of under 1 is considered healthy and balanced. Second, diversify strategically. Now is not the time to bet the house on a single team. Spread across defensive sectors such as utilities, healthcare, and consumer staples. Global market not directly hit by US tariff. And dividend growers for income while you wait. And third, position for policy. Recall that Trump's policies is equal to nationalism, tariff, and reshoring. That is good for local infrastructure and industrial, domestic manufacturing plays, and Malaysian exporters with US exposure. While it might hurt Apple, but it could also benefit local chip packaging, logistic hub, or supply chain alternative. Several US-based companies which may stand to benefit from the reshoring of Apple supply chains includes TSMC, Broadcom Incorporation, and United Parcel Service, just to name a few. Why this works? Because great companies don't just survive uncertainty, they grow through it. Buffett didn't make his fortune buying when it felt good. He made it buying when everyone else was scared. And right now, fear is back in fashion. So here's my questions to you. What's the one stock you are eyeing to buy if the market drops further? Drop it in the comment and let's help each other think like true investors, not just traders reacting to headlines. If this video has helped to calm your nerve and sharpen your strategy, don't forget to like, subscribe, and share this with your investing kakis. Because at Investment Mindset, we don't just follow the market, we outtake it. Bye and see you in the next video.